5 months. That's how long this has been going on. And I need you to understand what that number actually means. Not in price terms, not in dollar amounts, but in the historical record of this asset. Because right now, Bitcoin is sitting around $65,000, down more than 15% just this month alone, and on track to close February in the red. If it does, that makes 5 consecutive months of losses. The last time Bitcoin strung together a losing streak this long, it was 2018. And before that, it had never happened. Not once in Bitcoin's entire history had it declined for 5 straight months, except during the single worst bear market the asset has ever experienced. So no, this is not noise. This is not a normal correction. This is a historically significant signal. And in the next few minutes, I'm going to break down exactly what it means, what the on-chain data is saying beneath the surface, what the miners and the whales and the institutions are quietly doing right now, and most importantly, what comes next. Stay until the end because the last piece of this is the part that nobody's talking about. Let's get into it. First, let's establish exactly where we are. Bitcoin peaked at approximately $126,000 in October 2025. That was the all-time high. Since that peak, it has lost more than 48% of its value. Right now, as of this week, it is trading between $64,000 and $68,000. The price has declined every single month since that October top. October closed lower than September. November closed lower than October. December closed lower than November, January closed lower than December, and February, based on where price is right now, is on track to close lower than January. That is 5 consecutive red monthly candles. According to data from CoinGlass, this streak, if it holds through month end, will be the second longest consecutive monthly losing streak in Bitcoin's entire 15-year history. The only streak longer was 6 months, from August 2018 to January 2019. That bear market erased over 80% of Bitcoin's value from its prior peak. We are currently sitting at a drawdown of roughly 52% from the $126,000 top. The 2018-2019 drawdown's maximum reached 56%. We are 3.82 percentage points away from matching the deepest bear market Bitcoin has ever recorded, and we got here in just 123 days. That is not a number to gloss over. That is a structural reality that every Bitcoin holder needs to sit with and understand. Now here's what's important, and this is where most analysis goes wrong. A 5-month declining streak is not just a price event. It is a composite of everything happening in the market simultaneously: liquidity flows, institutional behavior, on-chain stress, miner economics, and macro positioning. The price is just the output. The real story is what's feeding into that output. So let's go layer by layer. Start with the liquidity picture. The single most important structural development of the last 2 years in Bitcoin was the launch of spot Bitcoin ETFs in the United States in January 2024. For the first time, institutional capital could access Bitcoin through regulated, familiar vehicles. And when that capital arrived, it transformed price discovery. BlackRock's IBIT alone pulled in billions in its first months. The ETF inflows became the marginal price setter. When flows were strong, Bitcoin went up. When flows cooled, Bitcoin stalled. That relationship is held with almost mechanical precision, and right now it is flashing a serious warning. According to data from Farside Investors and SoSo US-listed spot Bitcoin ETFs have recorded a 5th consecutive week of net outflows as of the week ending February 18, 2026. That 5-week outflow streak has drained nearly $4 billion from the product category. In a single week in late January, investors pulled $818 million in a single day. BlackRock's IBIT, which was supposed to be the flagship of institutional Bitcoin adoption, saw $317 million leave in a single session. The cumulative outflows from US Bitcoin ETFs since the October top now exceed $8.5 billion, or just let that number settle. $8.5 billion in institutional money that entered this market has now exited. And critically, what replaced it on the buying side? Not much. Retail is buying. Yes, small wallet holders are quietly accumulating, as they always do late in corrections. But retail buying without institutional fuel has never in Bitcoin's history produced a sustained rally. Not once. The faucet is still running, but the drain is wide open. Now let's go deeper into the on-chain signals, because this is where things get genuinely interesting. On February 5th, 2026, Bitcoin recorded the single largest realized loss day in its entire history. According to Glassnode's entity-adjusted realized loss metric, investors crystallized $3.2 billion in actual losses in a single day, not paper losses, actual losses. The day Bitcoin dropped from roughly $70,000 towards $60,000. That number exceeded the peak realized loss from the Terra Luna collapse in May 2022. It exceeded the FTX bankruptcy in November 2022. It is the largest one-day capitulation event Bitcoin has ever recorded. Capitulation sounds like a bad word, and in the moment, it absolutely feels like one. But here's what the data community knows about capitulation events that the average investor does not. They almost always mark the transition between the distribution phase and the accumulation phase of a market cycle. When investors who bought at higher prices finally surrender and sell at a loss, supply exhaustion begins. The sellers who were waiting to exit at break-even have now exited. The hands that were weak have now let go. That doesn't mean the bottom is in, but it does mean the composition of remaining holders is changing. The on-chain metric that tracks this most precisely is the MVRV ratio, market value to realized value. This indicator compares where Bitcoin's price is today to the aggregate price at which all coins last moved. When MVRV falls below 1.0, the average Bitcoin holder is underwater. When it approaches historic lows, it has historically aligned with major market bottoms. Right now, according to multiple on-chain analytics platforms, the MVRV ratio has dropped to levels not seen since March 2023, when Bitcoin was trading near $20,000. That is a significant signal, not a guarantee, but a signal. The data also shows that 42.85% of Bitcoin's circulating supply is currently at an unrealized loss. Nearly half of all coins are underwater at current prices. Again, historically, these readings cluster near cycle bottoms, not cycle midpoints. Let's look at another critical on-chain metric, the Net Unrealized Profit and Loss Indicator, or NUPL. According to analyst Guga On-Chain at CryptoQuant, NUPL has fallen to just 21.30%. For context, the last time NUPL was this compressed was during major bear market lows, and the Crypto Fear and Greed Index has hit a reading of 8 out of 100, a level of extreme fear that has only been recorded 3 times before: the 2018 bottom, the COVID crash in March 2020, and the FTX collapse in November 2022. Every single time that index has touched these readings, looking back, it aligned with what eventually became a major generational buying opportunity. I'm not saying that to generate excitement. I am saying it because the data says it, and ignoring that data would be intellectually dishonest. Now let's talk about the group of participants that most retail investors completely overlook: the miners. Because what is happening in Bitcoin mining right now is one of the most structurally significant developments in this market, and almost nobody is covering it at the depth it deserves. Bitcoin's current spot price is approximately $65,000 to $68,000. The estimated average production cost to mine 1 Bitcoin, factoring in hardware, electricity, and operational overhead, sits at roughly $87,000 according to data from Check and Chain. That means the average Bitcoin miner is currently producing Bitcoin at a cost that is more than 20% above the price they can sell it for. They are mining at a structural loss. That kind of environment does one thing historically with almost no exceptions. It triggers miner capitulation. Miners begin powering off rigs. Hash rate falls. The network's computing power contracts. And because miners must sell Bitcoin to cover operating costs and debt service obligations, their continued operation adds consistent daily selling pressure to an already stressed market. This is exactly the environment we are in. Bitcoin's network hash rate peaked at approximately 1.2 zettahashes per second in October 2025. By late January 2026, it had fallen roughly 20% to around 950 exahashes per second. That decline triggered the hash ribbon metric on Glassnode, the indicator that tracks the 30-day and 60-day moving averages of hash rate. When the 30-day average falls below the 60-day average, that is the hash ribbon inversion signal, and it historically marks periods of deep miner stress. The hash ribbon inverted in late November 2025, shortly after Bitcoin made a local low around $80,000. It has remained inverted since. And here is the nuance that most analysts miss when they see a hash ribbon inversion. Yes, it reflects real pain. Yes, miners are stressed. Yes, they are selling. But Van Eck, in an analysis tracking 12 notable hash rate contraction periods, found that the 90-day forward returns following such contractions have historically skewed strongly positive, with a median forward return in the high 40% range. Miner capitulation has, across every prior cycle, eventually removed the weakest sellers from the market and set the stage for the next phase of price recovery. The mechanism is straightforward. When unprofitable miners shut down, hash rate falls, difficulty adjusts downward, surviving miners become more profitable, selling pressure eases, and the supply overhang clears. On February 19, 2026, Bitcoin's mining difficulty spiked 14.73% to a record 144.4 trillion, the largest absolute increase in network history and the biggest percentage jump since China banned mining in 2021. That spike came after hash rate recovered from a Texas winter storm that knocked hundreds of exahashes offline. It illustrates that the mining sector is still producing enormous computational power despite the economic stress. But with hash price, the daily USD revenue per unit of hash rate, sitting at approximately $34 per petahash per day, close to break-even for most operations, the pressure remains acute. Now let's talk about the whale behavior layer, because this is where the smart money signals are hiding in plain sight. Data from the exchange whale ratio tracked by CryptoQuant recently climbed to its highest level in 10 months. This ratio measures what proportion of total exchange inflows come from the top 10 largest transactions. When this number rises sharply, it means large wallets are moving significant amounts of Bitcoin onto exchanges. Historically, that behavior is associated with one of two things: preparation to sell or large-scale institutional rebalancing. In the current context, with ETF outflows running concurrently and price in a sustained downtrend, the weight of the evidence leans toward continued distribution from large holders. Institutional wallets have, according to reported on-chain data, sold nearly 0.5% of total Bitcoin supply over the past 5 weeks. That is not a small number. The wallets that hold between 10 and 10,000 Bitcoin, the segment that encompasses institutional players, high net worth individuals, and sophisticated crypto-native funds, have been net sellers through this entire decline. Meanwhile, wallets holding less than 0.1 Bitcoin, the so-called shrimps, have been quietly accumulating. Their aggregate share of total Bitcoin supply has been climbing. This is the classic divergence that appears late in a distribution cycle. The largest players are moving supply into the hands of smaller retail participants, and retail is absorbing it dollar by dollar, week by week, with no idea that the institutional selling pressure above them is the reason price cannot sustain any meaningful recovery. The data on active addresses and transaction volume reinforces this picture. Bitcoin network transaction volume and active address counts have both declined meaningfully since October. Reduced on-chain activity implies weaker capital inflows. When fewer people are using the network, it signals that the excitement that drives speculative demand is absent. People are not moving Bitcoin because they are building positions eagerly. They are moving it because they are exiting. And then there is the macro layer, which in 2026 is impossible to separate from Bitcoin's price action. Bitcoin's correlation with the Nasdaq 100, the tech-heavy equity index, currently sits at 89% on a 30-day rolling basis. That is not a crypto story. That is a macro story. When institutional investors rotate out of high-growth, high-beta assets, Bitcoin is the first thing they sell. It is, as analysts have noted, at the highest beta end of the entire investable universe. When risk appetite contracts, no asset contracts faster. And right now, risk appetite is under sustained pressure from multiple directions. U.S. trade policy uncertainty has ratcheted up. Geopolitical risk has increased. The Federal Reserve has given no clear signal of near-term rate cuts, with inflation remaining sticky enough to keep policy restrictive. In this environment, institutions are rotating from growth assets, including crypto, toward value stocks, energy, industrials, and real assets. That rotation is not a one-week event. It unfolds over quarters. And while it is happening, Bitcoin functions as an ATM, a liquid 24-hour accessible source of capital that professionals sell to fund their repositioning elsewhere. Here is what all of this means for what comes next. And I want to be precise here, because precision is the difference between useful analysis and guesswork. There are 3 scenarios currently in play, and the data assigns very different probabilities to each. The first scenario is a continued decline toward the $60,000 region. This level is significant for multiple reasons. It represents approximately a 52% drawdown from the all-time high at current levels, and $60,000 would deepen that to roughly 52-53%. It aligns with the 0.618 Fibonacci retracement of the entire rally from the November 2022 low of $15,479 to the October 2025 high of $126,000. It is also a level where traders on the prediction market Myriad are currently pricing a 60% probability that Bitcoin reaches $55,000 before it reaches $84,000. That is not a trivial data point. Prediction markets aggregate real money and real conviction. A 60% consensus for downside does not mean the downside is guaranteed. But it does mean that the market's collective judgment, backed by capital, is that the path of least resistance remains lower. For this scenario to play out, you would need to see one of the following: a continued failure to reclaim the 78.6% Fibonacci retracement at 66,572, which Bitcoin has already broken below this week, a continuation of ETF outflows with no sustained reversal, or a macro catalyst that increases risk-off behavior, such as a Federal Reserve meeting signaling rates remain higher for longer. Watch the weekly close. If Bitcoin cannot close a week above $70,000 with meaningful volume, the $60,000 target stays live. The second scenario is stabilization and range consolidation between $60,000 and $75,000. This is what historically occurs during late-stage capitulation phases. When the largest sellers have mostly exited, minor selling begins to ease, and the market enters what some analysts call a dead zone. technically unattractive for buyers, but structurally becoming safer as the worst supply pressure lifts. For this to materialize, the hash ribbon would need to begin recovering. Specifically, the 30-day moving average of hash rate would need to cross back above the 60-day, confirming that miner capitulation is ending. It would also require ETF outflow rate to slow or pause, even if not reverse. Watch the weekly ETF flow data published by Farside Investors. If the 5-week outflow streak breaks without a new leg lower in price, that is a first signal that the selling pressure is exhausting itself. In this range scenario, the key support to watch is $63,800 to $64,300. Multiple technical analysts have flagged this zone as the level where a potential double bottom could form. Above this, there is structural support. Below it, the technical picture opens significantly to the downside. The third scenario is a recovery leg, and the setup for it, while not yet present, is closer than most people realize. For a genuine recovery to begin, the historical pattern from every prior Bitcoin cycle is clear. It requires miner capitulation to complete, ETF flows to return positive and sustain for multiple weeks, and a macro catalyst to remove the primary headwind for risk assets. The most commonly cited catalyst in the current environment is Federal Reserve policy. Analysts at multiple institutions, but including CoinShares, have pointed to the second half of 2026 as the most likely window for a Bitcoin recovery, contingent on the Fed beginning a rate cut cycle. If inflation continues to ease and the labor market softens, the conditions for rate cuts improve. When rates fall, money becomes cheaper, risk appetite returns, and the assets that were sold most aggressively in the risk-off phase tend to recover first. Bitcoin, as the highest beta asset, often leads that recovery with outsized moves. Historically, the periods immediately following major capitulation events, February 5th's $3.2 billion single-day loss being the largest in history, have been among the most productive for investors with patience. The 2022 analogy is instructive. Bitcoin formed its final low at 15,179 in November 2022 during the FTX collapse. That was a moment of maximum fear, maximum capitulation, maximum institutional exodus. 18 months later, Bitcoin was above $70,000. The people who bought when the Fear and Greed Index was at 8, which is exactly where it sits today. Those were the people who participated in the recovery. Let me give you the specific levels to watch going forward, because the analysis is only useful if it translates into something actionable and observable. On the downside, $63,800 to $64,300 is the first critical zone. A weekly close below $63,800 opens technical risk towards $60,000 and potentially $57,000. On the upside, Bitcoin needs to reclaim and hold $70,000 on a weekly close to begin shifting the near-term structure from bearish to neutral. That level is not just a round number. It is where multiple moving averages and prior support-turned-resistance levels converge. A weekly close above $75,000 with expanding volume would be a more meaningful structural break, suggesting the descending formation from the $126,000 high is being challenged. But you need confirmation, not anticipation. Do not trade the expectation of a breakout, trade the evidence of one. In terms of on-chain signals to monitor, watch Glassnode's accumulation trend score. Any sustained reading above 0.6 across multiple weeks, not just a single spike during a panic event, signals that meaningful accumulation has resumed. Watch the hash ribbon for a bullish crossover, which would confirm that miner capitulation is ending and selling pressure from that cohort is about to ease. And watch the weekly ETF flow data. Until that data shows at least 2 consecutive weeks of net inflows, the structural supply headwind from institutional redemptions remains intact. Here's the bottom line, and I want to say this clearly. 5 consecutive months of decline is a historically significant event. It is not something to dismiss with Bitcoin always recovers energy. It requires honest acknowledgement. The market is in a stressed state. Institutional money is exiting. Miners are under severe economic pressure. The macro environment is not supportive. And the technical structure remains in a downtrend from the all-time high. All of that is true. But also true is this. The capitulation metrics are at levels that have historically, across every prior cycle, preceded recoveries. The MVRV is at March 2023 levels. The Fear and Greed Index is at 8. The realized loss event on February 5th was the single largest in history. These are not random numbers. They are the signature of late-stage capitulation. The market is not halfway through a decline. It is behaving like a market that is nearing the point of maximum pain. Whether that point has already passed or is still slightly ahead, no model can tell you with certainty. What the data can tell you is that the risk-reward of holding into strength is very different from the risk-reward of panic selling at current levels. The people who sold Bitcoin at $15,000 in November 2022 were right for a few months, and then they were very, very wrong for the next 2 years. Positioning right now is about understanding probability, not certainty. And the probability distribution, based on every historical analog available, does not favor adding aggressive short exposure at these readings. That doesn't mean you chase. It means you watch. It means you track the signals. And when the evidence shifts, when the hash ribbon recovers, when ETF flows reverse, when the MVRV crosses back above its mean, you move with conviction, not before it. This is still unfolding. The market has not given its final answer, but the data is building a case. And now you know exactly what to look for. If this breakdown gave you a different way of reading what's happening right now, not through the noise of social media, but through the actual structure of the market, drop a comment below and tell me which signal you're watching most closely. I read every single one. Like this video, if the data first approach is what you come here for. Subscribe if you want this level of analysis every time something significant shifts in this market. Because in an environment like this one, the edge doesn't come from guessing. It comes from knowing what to watch and being ready when the signal finally arrives.